Here's rule number 13 of our 20 rules for investment success. Current quarterly after-tax profit margin should be improving, near a peak, and among the best in the stocks industry. To calculate profit margin, take a company's net income and divide by sales. Profit margin is calculated on a quarterly or annual basis. A firm with a profit margin of 50% is generating 50 cents of profit for each dollar of sales. Keep in mind that profit margin varies by industry. For example, technology firms will have higher profit margin than supermarket stocks, which have higher operating costs. You don't have to worry about finding this information on an income statement. IBD's SMR rating stands for sales, profit margin, and return on equity. Stocks are rated on an A to E scale, with A being the highest. Each stock is compared against all others, so you can easily see how it stacks up. By looking for stocks with A or B ratings, you'll be able to better zero in on those with strong after-tax profit margin. Profit margin also comes into play with rule number 14. Don't buy a stock because of dividends or PE ratios. Buy the number one company in an industry group based on earnings and sales growth, return on equity, profit margin, and product quality. You can become a more successful investor by focusing on your stock's earnings strength, including its profit margin, rather than its price-to-earnings ratio, or whether it pays a dividend. Don't avoid stocks simply because you think the price-to-earnings ratio is too high. Always look at a stock's PE ratio in relation to its growth rate. For example, a stock with a PE ratio of 40 that has a growth rate of 100% is arguably cheap. It's very common for great stock market winners to have PEs well above the market average at the time they began their biggest price moves. Apple Computer was a leading stock in March 2004. This stock had a PE ratio of 56 as it was rallying out of a consolidation, or what we call a base. So don't miss out on potential winners because the PE seems too high. As far as dividends, some of the better firms prefer to reinvest free cash into the growth of the business rather than pay it out in the form of a dividend. Often, it's the more mature companies that pay dividends instead of the younger, more entrepreneurial growth companies. So rather than look at PEs and dividends, look for stocks with strong earnings and sales growth with an innovative product or service. Next up in our 20 Rules series, rule number 15. Pick companies with a superior new product or service.